interest rates will come down this year for a few reasons. And we believe we've been through rolling recessions. In the United States, some measures of housing are down by 40%. If you look at the metals price index, so broad-based metals divided by the gold price index, you will see that that correlates very well with long-term interest rates. Broad-based inflation goes negative, that we see deflation. And I think the Fed will ease aggressively as that happens. Interest rates will come down this year for a few reasons.
Cathie Wood, a visionary investor and founder of ARK Invest. In this video, she will share her views on the outlook for inflation, deflation, recession, and monetary policy in the U.S. She will address some of the key issues that many people are concerned about, such as: is inflation transitory or persistent? And what are the main drivers behind it? How likely is a recession in the U.S., and what are the signs to watch out for? What will be the impact of deflation on the economy, and which sectors will be most affected? How will the Fed respond to the changing economic conditions, and what are the implications for interest rates and the dollar? How can investors prepare for the challenges and opportunities ahead? Let's hear the answers to these questions from Cathie Wood.
One, we believe that investors will conclude that inflation was transitory. It was much more because of a supply-side shock, supply chain bottlenecks, than it was about monetary policy. In fact, the money growth has been negative on a year-over-year basis for the past year, and the yield curve has been inverted for a year and a half. Those are harbingers of recession. And we believe we've been through rolling recessions. In the United States, some measures of housing are down by 40%. If you look at the sum total of new and existing home sales, they're back down where they were in 2008 during that crash.
Wait a minute, everyone. Get ready for the ultimate crypto investing website, the Bitcoin Seller. It's your golden ticket to an exclusive insiders club. Expert predictions, on-chain data, and breaking news, all for you. Imagine all crypto insights landing in your inbox daily, like having your own expert team. Don't miss this VIP opportunity. Click the link and secure your spot. Join now and ride the crypto roller coaster with the Bitcoin Seller.
And so housing's been in a recession. Auto sales are, I would say, they are not in expansion territory. They're very weak by historical standards. Commercial real estate, especially with offices, is unwinding. We expect to see a lot of defaults. And now that companies have lost pricing power, many did use COVID as an excuse to raise prices, and the consumer said, no mas, no more. And of course, they are now cutting prices. So we think the big surprise in 2024 is that broad-based inflation goes negative, that we see deflation. And I think the Fed will ease aggressively as that happens. We're seeing even food companies like Conagra are saying, you know what? The consumer is not coming back. And the consumer has to eat. What they're doing is they're trading down and are not willing to pay higher prices for, higher end goods. So it's very interesting to see even the staples companies saying, oh my gosh, our units are down. That rarely happens.
Cathie Wood discusses the outlook for inflation, deflation, recession, and monetary policy in the U.S. She argues that inflation is transitory and caused by supply chain disruptions, rather than by excessive money creation. She warns that the U.S. economy is facing a high risk of recession, as indicated by negative money growth and an inverted yield curve. She expects deflation to set in 2024, driven by changes in consumer behavior, higher interest rates, and lower corporate profits. Inflation has slowed. Now the Federal Reserve faces expectations for rate cuts. Inflation has slowed down to the Fed's 2% target level, after peaking at 7.1% in June 2022. It says that the Fed is expected to cut its benchmark rate 3 times this year, starting from May or June, to support the economy. It also mentions the political pressure that the Fed faces from former President Trump, who criticized the Fed for raising rates during his presidency.
Well, we think they made a mistake in raising interest rates 24-fold. So not 24%, but 24-fold over little more than a year's time. And we're going to see a lot of fallout from that, we think, in the next year. We saw the first fallout, which was the regional bank crisis this past March in the U.S., and so we're still seeing outflows from regional banks. So their problems have not gone away. These high interest rates in money market funds are a tremendous amount of competition for the banking system. So deposit outflows are continuing, and that's why money growth, M2, is down on a year-over-year basis. The big surprise is going to be deflation. Certainly to the Fed, they don't think it will. They think they're going to have trouble getting inflation to 2%. We think it's going to go to 2% and continue down. If you look at the metals price index, so broad-based metals divided by the gold price index, you will see that correlates very well with long-term interest rates, especially since 08-09. It's really remarkable. Until last year, the metals to gold ratio went to its lows, the lows since 08, and the long-term treasury yield went out to 5%. If this correlation were to have continued, and we think it will, interest rates should be at 2%, not 5%. So we don't know if long rates will get to 2% this next year, but we think they're going to go down a lot more than most forecasters believe. One of the reasons, as I mentioned, is deflation. The other reason is if we're right and companies have lost pricing power, they're going to have to cut their prices. That's how we get deflation. And they're probably going to lay people off because their margins are going to come under extreme pressure. And so the unemployment rate will go up, and that means consumption is the next shoe to drop in this rolling recession. Now, because the recession has been rolling, we would say for 2 years, it's not going to be a severe recession like 08-09. This is just this is the tail of it. But it is an election year here in the United States. We think the government is going to be under all kinds of pressure to stimulate. And on the fiscal policy side, we know that gridlocking Congress is going to prevent much from happening at all. Nothing. We would be surprised to see much happen. And so the policy that will need to address this situation is monetary policy.
And do not forget to subscribe to Bitcoin Seller. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.